All right, so California and ERCOT were the ones that we're going to go into greatest depth on. So I'll try and stay a little bit lighter in some of the other ISOs so that we can have a little bit more time for Q&A at the end. As you look at New York, we'll kind of do New York next. New York, one of the states that has a clean energy mandate. So we expect a lot of renewables to be coming in. A lot of that's going to be offshore wind, a lot of solar. You know, that's kind of the dynamics. There's a lot of old thermals in New York that are very likely to retire, and so very much a need for storage to fill some of that gap. So that's the big picture. You've got a mandate to get clean. You got thermals retiring, renewables coming in. Storage is going to be a critical part of the mix. The other big consideration for New York is kind of the upstate downstate divide. So if we look at kind of all the upstate resources, these are almost all clean. So all the hydros up here, there's a lot of nukes up here. This is a very clean grid in the upstate. Downstate is a very different story. So a lot of the carbon emissions are downstate. There's also a lot of load downstate. So kind of the ability to get the clean energy from upstate where you have open space and you have clean energy and get that down into the population centers downstate is an ongoing challenge. So that's like one of the biggest critical considerations for New York. Our forecasts for New York are that prices stay roughly flat in nominal terms, so declining in real terms. And so what's happening here is that we have a carbon price that's increasing over time, and we have gas prices that are increasing over time, and we have renewables coming in, pressing those prices, and kind of the net impact of all three is that they stay relatively flat. But the implied heat rates are continuing to decline. Capacity prices we expect to increase over the next few years as thermal retires and things tighten up, and then to pretty much stay high, but level out as the supply mix continues to churn, storage becoming kind of increasingly replacing some of these thermal retirements. For volatility, the volatility in New York is lower than California and ERCOT. But we expect it to grow, and because of some of the permitting challenges in New York and project delays, we do expect a disequilibrium period in New York as well, but that coming in a little bit later and being a little bit shorter than some of the other ISOs. Part of the reason that it will be a little bit shorter is that it'll be coming when storage is a more mature market, so we expect a little bit faster of a catch up in New York than in some of the other markets. So main story for New York, there's policy mandates. Those are really driving continued build out of renewables and storage. Growing penetration will kind of hold prices flat in nominal terms. We will expect to see some duckiness start to set in New York, not anything like the duck of ERCOT or California, but as that solar deployment grows, more depression in midday than in the evening and ramp hours. There's going to be ongoing congestion from upstate to downstate. There's going to be open land upstate. There's going to be solar going in upstate. Onshore wind will come in upstate. But the populations are still downstate. And so there's still going to be that congestion to get that generation into the downstate region because there's just no space. The build out of offshore wind helps with that a little bit because that offshore wind certainly will interconnect to some of that downstate area. But there's still going to be congestion. There's still going to be difficulty in kind of getting power into the super dense downstate New York area. So good opportunity for flexible generation and storage, not as good as California and ERCOT, but between policy targets and renewable mandates, it should be a good opportunity, storage being profitable by the late 2020s. ISO New England, let me actually jump, okay, I'll stick with ISO New England. ISO New England, renewable penetration, again, being driven by state goals. There's not great solar resource in New England, but state policy goals are kind of pushing, Maine being one of the biggest ones, Massachusetts next. Clean Peak Standard in Massachusetts also creates a good opportunity for storage in particular, to be able to provide energy during Clean Peak standards, during Clean Peak hours. So we see a lot of renewable growth in New England. We look at the supply stack. Again, a lot of solar, a lot of rooftop solar, a lot of offshore wind. Interconnection queue, you can see, is basically wind, solar, and batteries. A little bit of gas, but mostly wind, solar, and batteries. Most of this wind is offshore wind. So if we look at kind of state goals for offshore wind, we look at federal goals for offshore wind, we look at the interconnection queue. A lot of the wind coming into New England, very, very likely to be offshore. And that's going to be a key story is the integration of offshore wind. Similar to New York, our forecast has increasing gas prices, increasing carbon prices, and power prices staying pretty flat in nominal terms, kind of as the net impact of all three. So declining implied heat rates, but flat prices. Capacity prices, we are working on a refresh. We'll have a new capacity price forecast out very shortly for New England that's a little bit different than this one. But they've been declining in recent years. We expect them to incline or to increase moving forward. There's going to be thermal retirements, particularly as some of the renewables come in. Eventually, batteries are going to become a marginal resource, and once that happens, we expect the capacity price to really reflect the net killing of batteries. Volatility in New England is very, very low. So if we look at volatility today, it's got a long ways to go before it'll make economic sense for storage. Our forecast is that it's going to take a very long time for volatility growth to hit a point where storage makes economic sense. And by the time it finally does, there's not going to be any kind of disequilibrium period that we saw in some of the other markets, that we forecasted in the other markets. So, storage is going to take a while before it makes sense without subsidies. The Clean Peak credit could be part of that subsidy, but without having access to that, or without that being a driving force, it's hard to see much opportunity for storage in New England. But really, the story in New England is offshore wind. So offshore wind is going to depress prices. It's going to drive some volatility. It's going to be a little bit different than some of the other wind penetration regions because offshore was a little bit more reliable than onshore, and so much of the wind in New England is going to be offshore. There's just not as much land to build stuff. So onshore wind is more difficult. Utility scale solar is more difficult. There's not a great solar resource either. So offshore wind is going to be the key driving force for the market dynamics in New England. SPP, wind is the story in SPP, right? So when we look at SPP, best wind resource in the country, tons of wind, not a lot of load. We see the wind penetration is already high. We see it continuing to grow. The other piece, though, is that there's a lot of solar coming in too. So when we look at the interconnection queue for SPP, despite the fact that it's already very wind heavy and they already have quite a bit of wind curtailment, there's more wind coming in, quite a bit more wind coming in. And there's also a lot of solar coming in because the solar resource in the SPP Midwest area, it's not bad. And so, solar is increasingly showing up as a resource, and our expectation is that that'll continue to grow because the solar resource is pretty solid. We also expect coal to retire by mid-2030s. Coal is already struggling. Prices in SPP are extremely low, and really not generating enough margin for coal resources. But it'll take some time before some of the utility-owned coal stops self-scheduling, doesn't have rate recovery, or once it stops self-scheduling, that's when it will start to retire. The fact that the utilities have rate recovery is what will allow it to continue to stay in this long. But we expect coal retirements to be greater than what's been announced. It seems like every couple of weeks there's a new announcement about several more gigawatts of coal that are slated for retirement, and we expect that trend to continue. The economics of coal are really, really struggling in SPP, and so we expect that decline to be rapid. That price depression is strong. So similar to what I showed for California, when those renewables hit 40–50%, those negative prices take off. 40–50%, those negative prices take off. It doesn't matter whether you're looking on peak, off peak, real time, day ahead. 50% is really the threshold. And it's not that you can't accommodate more than 50%. You just can't really accommodate more than 50% without having curtailment. So we see that increasingly often. We look at negative prices in 2013 compared to 2019, more and more common. If you look at these percentage, these are LMPs where the percentages are, negative prices 20% of the time, right? That's, 20% of all hours in the year are negative. That's a ton of negative prices, and more wind is coming into this, and more solar is coming into this. And so that's a really critical part of the story in SPP. It's just lots and lots of renewables without really anywhere for them to go. And more price suppression. And the thing in SPP is that prices are already low. So, prices on average, 25 bucks on peak, 15 bucks off peak, ATC average around 20. Those are really low prices. Forwards say that they're going to go even lower, right? So market forwards are expecting those to come down even more. Our expectation is that when we look at the queue and we look at the dynamics of what's going on with renewables coming in, they're going to come down even further. Carbon prices are the only thing in our forecast that help buoy those prices and prevent them from going extremely low. Low prices staying low is the story for SPP. And this is where that potential for corporate off-taker demand becomes a key part of the story, because you look at wind generation at 15 bucks a megawatt hour, it's just barely making it with these prices. But if you have corporate offtake demand, then that's part of what helps buoy that continued development despite these low prices. Volatility forecast, because there's so much renewables and so much volatility, we do expect the volatility growth to give a little bit of a disequilibrium window, but not a huge one. And a lot of that volatility shows up in negative prices. So the revenues, it's tough for the revenues in SPP because you don't see the big positive price spikes that you really need from load pockets to really drive revenue generating volatility instead of just lots of negatives. A lot of the volatility shows up in negative prices. So big story in SPP, coal retiring, solar accelerating. Very much we see a lot of solar coming in, and winds continuing to grow. And all that together means prices just stay low. And so, thermals that are hoping for a price recovery, I think are going to be very disappointed. Let me pause for maybe just one or two questions here, and then we can jump into PJM and MISO to finish up.
From Nicole Tran, what effect do you think offshore wind will have on the ancillary / arbitrage market for storage in ISO New England?
That's a good question. So offshore wind, we do expect that it's going to drive volatility. I mean, it's still an intermittent energy source. It's not as intermittent as onshore winds. It doesn't gust quite up and down quite as badly, but it's still a large energy source with intermittency. And so that intermittency is going to create net load ramps. Those net load ramps and forecast error are going to create a need for flexible resources. And so definitely going to drive increased ancillary requirements, definitely going to drive increased volatility, which is going to increase that arbitrage opportunity. As I said before, though, even though it'll increase the ancillary requirements, these ancillary markets aren't deep, and so we still expect them to saturate. And if you look at the storage targets in the ISO New England states, the targets alone will more than saturate those ancillary markets. So ancillaries will, in our view, we expect ancillaries to decline to basically parity with energy arbitrage. But certainly that volatility and that arbitrage opportunity will grow as the renewable penetration grows, of which a lot will be offshore wind.
One more?
Yep.
Okay.
So Tom, did you say there was one more?
Yeah, sorry about that. You said a number of times, this is Ryan Gerlach, you said a number of times that when renewables reach 50%, prices go negative. How much storage would be required to offset this dynamic, i.e. keep prices above zero?
Yeah, so that's a good question. One of the questions you have to think about is what level of price would make storage want to charge, right? So, even if you had tons and tons of storage on the system, would they want to charge if charging was going to push prices up to, you know, 10 bucks a megawatt hour, 20 bucks a megawatt hour? And so our general expectation is that it takes quite a bit of storage to cause prices to lift up above zero. Like when they're below zero, you know, everybody wants to charge. And so what you can do is you can decrease the amount of curtailment, but it's much more difficult to put upward pressure on the price. Because if you're storage and you're going to bid, you know, $0 as your charging price, then no matter how much storage there is, that price doesn't go above zero. So the question is, what's the floor bid that storage is likely to put in? And that's a much more difficult operational question, which also relates to what's your expectation for future prices, you know, because the arbitrage opportunity, you have to understand the high in order to understand what the low is that you're willing to charge at. And if you think the high is only going to be 60, then you probably don't want to charge at 30. But if the high is going to be, you know, 1,000, then charging at 30 is no problem. So our general expectation is that the build out of storage will have a much bigger impact on the quantity of curtailed energy than on the prevalence of negative prices. You know, it'll maybe push them up to zero, but it'll take a lot more to lift that floor off of zero.
Terrific. Okay, folks, we're in the final 15 minutes, so we have a little more ground to cover. I want to say thanks for being here today right up front, and then the next workshop will be October 2021. This will be on battery storage. Brent, your floor.
Great, thanks. I know that PJM was a market of interest to people, and so I did want to make sure that we got to PJM. I'll probably go pretty quickly through MISO, and then we can do a few more questions before we finish up. So PJM, renewable policies are a part of the picture. So we look at Virginia, 100% by 2045. New Jersey and Maryland, both pretty strong. Illinois has some aggressive policies as well. Ohio, Pennsylvania, likely to become more aggressive in the future. So we expect renewable penetrations to grow and to be higher than what the policy mandates say. So when we look at the supply stack, one of the kind of most stark things that I think is worth pointing out is our forecast for coal. So we expect coal and PJM to be done by 2030. We look at the capacity auction that just came through. You know, there's the vast majority of capacity of coal capacity didn't clear. I'll have a slide on this in a second. Or you know, is uneconomic, and so coal is just in a hard spot in PJM. So we expect, you know, almost 80% of the supply to be nuclear, hydro, and renewable by 2040. So a lot of clean energy, a lot of clean supply. Coal really struggling. Nukes likely to get subsidies to stay in. You know, we've already seen that being talked about in Illinois. Already seen it implemented in New Jersey. We expect that to be kind of a trend through the region is to keep nuclears online via some external mechanism. PJM is also planning to remove the MOPR. FERC wants them to remove the MOPR. They want to remove the MOPR, minimum offer price rule. So subsidies to nukes are likely to be able to allow nukes to stay in. But you know, thermal retirements are going to be a critical part of the story for PJM. So you know, retirement's coming. We've got declining capacity factors. We've got price depression from renewables and low natural gas prices. Tons of renewables coming in. Declining capacity prices, partly from incoming renewable and storage capacity. It's a triple whammy for inflexible, high fixed cost thermal generation. So if you're inflexible, you're not being able to follow price signals well. High fixed costs as your capacity factors decline. It's a tough spot to be in. And if those capacity prices aren't allowing you to stay afloat, it's a tough spot. So you know, I saw this article just a few days ago. Most coal plants in PJM are becoming money losers. About 70% to become uneconomic in 2023. You know, this decline of 2/3 in the capacity market in the most recent auction just puts a lot of coal in a very, very tough spot. So retirements are going to be the story. Forecasted prices, we have prices, again, you know, you've got, in some places you're going to have RGGI prices, but gas prices going up, power prices, we have staying roughly flat in nominal terms. So that's where we see things going. Capacity price forecast, we, like most people, very much missed the mark in this most recent auction. We did not expect a 2/3 drop. And it'll be interesting to see what happens. Our expectation is still, though, that, especially after this most recent auction, those very low capacity prices are going to force a lot of thermal retirements. And as those thermal retirements continue, that the capacity market will tighten up. And we expect prices to return back to about where they were before, which was around $50 a kilowatt year. The Northeast PJM used to trade at a pretty significant premium. We expect the if New Jersey nuclear subsidies continue to be in place, we expect that premium to pretty much collapse down to the rest of the RTO region, just because of the impact that subsidy will have on the supply stack for that region. But it's going to take thermal retirements to tighten that capacity market back up. PJM volatility, historically extremely low. We think it's going to take a very, very long time before that comes up to an equilibrium level for storage. So we don't really see a great storage opportunity in PJM without having contracted revenues. So the real market opportunity in PJM is corporate off-takers. So that's without having a contracted revenue of some form, we don't see a great market for storage here. So main story for PJM: retirements, renewable build out, corporate demand, and flexible generation and storage are going to be needed to get some of these renewables integrated, but the time frame for the economics for storage aren't really until the 2030s. So let me touch on MISO, and then we'll take some final Q&A at the end. MISO's interesting. There are a handful of states that are signaling support for 100% clean energy. There are some renewable standards. I think it's very likely that some of these states, Wisconsin, Illinois, Michigan, Minnesota, very likely to go in the 100% clean energy direction in the near term. So variety of clean energy targets. Pretty good wind resource, pretty good solar resource in the south, wind in the north. So we expect that to continue to grow. If you look at the interconnection queue, there's a lot of solar in the interconnection queue. There continues to be wind in the interconnection queue. MISO, because it has a lot of utilities that self-schedule and operate their own fleets, we expect coal to last longer, but to continue to decline and phase out over time. Like PJM, we expect coal retirements to be greater than announced. As the Sierra Clubs of the world continue to put pressure on utilities to stop self-scheduling them, eventually that pressure is going to start to win out. So in our forecast, prices stay pretty low, pretty flat until carbon prices start to push those prices up. Again, that's that carbon price forecast that I've mentioned before. In the 2030s, that's where our forecast has enough solar build out to really start to push down the on-peak prices. We really see prices starting to get more and more ducky, particularly in the 2030s. So in the 2030s is where we really see, we really expect more of a duck shape to start to show up. For the capacity auction MISO is interesting because it's a voluntary auction. Most utilities are long on capacity and want to stay long on capacity. So capacity prices historically have been very, very low, $1-2 a kilowatt a year compared to, 70, 80, 100 in California. We expect that to continue to be the case. What you see in MISO is that some of the constrained regions, particularly Illinois and Michigan, will occasionally swing from something extremely low to basically net cone. And so that, we expect that to kind of continue occasionally, but in general for prices to be very, very low and most utilities to stay long. Partly because the utilities in MISO are so long, the supply stack is long, and because the supply stack is long, we don't see much volatility in prices. You just don't really move into the, more limited parts of your supply stack very often. You have a lot of ramping capability because you have so many resources that are self-scheduled and online. So we just don't see a lot of volatility there. We expect it to grow as thermals retire and as renewables come in. But basically never even hitting a point where economic equilibrium gets reached for a battery. So we don't really see an economic market for storage in MISO unless it's contracted. Really, it just needs to be contracted. So we expect the supply in MISO to stay long, and even as renewables grow, that long supply will really mitigate the market opportunity for storage. So MISO is not a great market for storage unless you have a contracted resource. So let me jump to some conclusions, and then we'll do some final Q&A. We expect renewable penetrations to rise rapidly, pretty much across markets, going much beyond current levels. Some people will say, well, in order to reach these renewable targets, we're going to have to basically do, our best year ever of renewable build out and then double that every year. Well, I think that's not unreasonable. We're already looking at interconnection queues where that's happening. So there's a lot coming in, and it's going to be a fundamentally different paradigm than what we've seen in the past. We expect a lot of thermal retirements, particularly in those markets where renewable generation is coming in fast and displacing those capacity factors from the thermals. It's going to eat into the margins. High fixed cost resources are going to be in trouble. We expect price volatility to grow across markets. The need for storage is already pronounced in Texas and California, and that's only going to spread to other markets as renewable penetration grows. We see geospatial dynamics becoming increasingly important. Renewables going into low population density areas, load being in the high population density areas, and the constraints for getting energy from one point to the other is increasingly being an issue. And so challenges associated with getting transmission built are going to continue to be there. And then flexible capacity is going to need to be the complement. So storage, RICE units, CTs, if they operate at low capacity factors, that's not a bad thing. We need to rethink this way of thinking about stranded assets. Low capacity factors are great. Those are capacity resources that are providing reliability while you get your cheap energy from your cheap renewables. So I showed this slide last time. We live in a digital world. Are you making decisions with analog technology? As we look at these market outlooks, we're looking into the future. Does your market forecast, does your market outlook think about the future, or is it anchored to the past? We are very much trying to account for these variety of push and pull factors beyond just what a simple economic model tells you. And we're also looking at volatility, which is a critical driver, is driven strongly by renewable penetration, and it's a critical driver of value for flexible resources. So we have to make sure that we're properly accounting for the value of flexible resources if we want to communicate and understand the value that they bring to the system. So market intelligence, this was really just a taste, just a sampling of what we cover in our reports. I went really quickly through MISO and PJM and SPP in New England. We have full market reports for all of those markets. We have forecasts for all the markets. We provide price simulations. We have historical data visualizations. So a variety of offerings that we can provide. I always say that even if you already have a market forecast you like, it never hurts to have another one, because we're all looking into the future with a lot of uncertainty, particularly at an inflection point like we're in now. And so, having multiple lenses and multiple views can be helpful. And so we do provide all that. And, I think the way that we think about the market is fresh and reflective of how the market is changing, not just how it used to be. So let me pause there, and maybe we can take some final Q&A, and then we'll send you on your way.
Okay, a couple of questions. This one starts, since we're just talking about MISO. Historically, there have been a large percentage of renewable resources in MISO. The MISO queue don't actually get built. What do you expect the majority of projects in MISO and other queues to actually be built?
Yep. Now, when we look at interconnection queues to inform kind of the next few years of our supply stack models, we certainly do not assume that everything gets built. There's a lot of project positioning, a lot of kind of exploration, holding your spot in line. So a lot does not. When we do our forecast, we're looking at the stage of development of the project, historical success rates. So we might, depending on the market, it might be 15%, 20%. That might depend on whether it's the definitions vary by ISO, but for ERCOT, for example, does it have a signed interconnection agreement? Does it have posted financial security? And if it has both of those things, then it's extremely likely to get built. If it doesn't, then much less likely. And so we're looking at both stage of development and success rates when we look at the queue. So we're not saying that everything in the queue is coming in, but if you look in the queue and it only has wind and solar, then we can pretty confidently say that only wind and solar are coming in. When we look at kind of how much we expect to come in, it's quite a bit. MISO, for example, has many gigawatts each of wind and solar in the queue. We don't expect all of it, but I don't remember off the top of my head what our assumed success rates are for MISO, but I think they're in the 15% range. But again, that depends on stage of development.
Excellent. Okay, we're at the top of the hour. Two things I want to talk about. Ascend Analytics will be going to SPI New Orleans. We're traveling again. So we hope to see some of you in New Orleans in September. And then number two, I mentioned it once, but I'll mention it once again. Our next workshop will be on battery energy storage, October 2021. Watch for details on that. If there are any topics that you especially would like to see between now and the end of the year, you've gotten a taste of what Brent could do. Drop us a note and we'll try and fit it in. We look forward to seeing all of you again. We're delighted that we're coming out of a year of weirdness and be back into a position with be able to see you all again. Take care, enjoy your summer, and we'll meet you next time.
Thanks, everyone.